Hello everyone and welcome to this session where we discuss your AS7. This is on construction contracts. It's an important standard and you will get a numerical question if this comes in your exam, unlike maybe a similar AS9 where you get a case-based question. So when you look at AS7, this is specifically for your construction contracts. Now usually revenue will be recorded as per AS9, that is in case of goods when the risk and reward incident of goods gets transferred, or in case of services when the services are actually rendered. However, AS9 on revenue recognition has a scope exclusion whereby they say that if the revenue arises for a contractor in the course of construction contracts, then the revenue should be recorded as per AS7 and not as per AS9. So what is a contractor and what is a construction contract? A construction contract is typically a contract which takes a long period of time to be completed, like for example takes more than a year to be completed, and this can be in cases of companies like L&T Construction or Hindustan Construction Company HCC, who are in the business of constructing roads, bridges, highways, buildings, etc. Now these contracts might inherently take a long period of time. Now the question is, why do I need a separate standard? What was AS9 not covering that we needed a separate standard in the form of AS7? Now the problem in AS9 is they would say that these items you should recognize the revenue when the risk and reward incident to ownership is transferred. So for example, if you are constructing a bridge, let's say in Mumbai you are constructing the Bandra-Worli sea link. It's a 7-kilometer bridge over the sea which let's say took around 5 years to be ready, in which case ideally if HCC, which is a contractor, is constructing the bridge for the government for which it is going to get 10,000 crores, HCC will recognize the revenue when the bridge is complete, that is the risk and reward incident to ownership of the bridge is actually transferred to the government. Till that time HCC will not be recognizing the revenue, and as a result the problem in this particular process is that for 4 years we are incurring cost to construct the bridge. However, there will be no revenue, and then suddenly in the 5th year, boom, there's a huge revenue. Further, you take another project, another 3-4 years, there's a lull, and then suddenly once the project is completed, there is a huge revenue. Now the problem is, every infrastructure company or construction company is going to face this issue, and as a result, if I were to meet my basic criteria of comparability, if I want to compare the financial statements of two construction companies, it is very difficult to do, because in one of the years there might be very less revenue, but does not mean that the company is not doing well. Well, maybe it is executing projects which are not yet complete, and hence the financial statements become very unpredictable, non-comparable, and hence the standard says let us not apply AS9. In fact, put up a separate standard due to the special nature of construction contracts and give special guidance for these contracts. So that is the background behind AS7. Now AS7 mentions that there are two types of contracts. One is a fixed price contract where we say that we'll construct the bridge and the government says that they'll pay us 10,000 crores. Fixed price contracts, or there might be something called as a cost plus contracts where we don't know exactly how much the cost would be. So because it's a very complex arrangement, and hence we say that whatever is the cost incurred, and you can get that audited, whatever is the cost incurred plus that a profit margin, let us say of 10%. So that is a cost plus contract. Either of these types of contracts, accounting will be done as per AS7. Now when you do accounting, what do? Well, you show the contract revenue to be recognized, the contract cost to be recognized, and consequently the contract profit. Now the thing is, usually revenue as per AS9 would have been recorded when the risk and reward is transferred. However, for AS7 a special case would be applied, and they would say that construction contracts revenue will be recognized based on the stage of completion, based on the percentage completion method or proportionate completion method. So in 1 year, let us say out of a 7-kilometer bridge, let's say 3.5 kilometers are completed, that is 50% of the work is done. We can say that means we can recognize 50% of the contract revenue. Now this is irrespective of the fact that the risk and reward incident to ownership of the bridge has not been transferred. However, still, because 50% of the work is done, you can recognize 50% of the revenue, and this is the biggest contribution of AS7. So generally they say that in case of a construction contract where outcome can be reliability estimated. Now what does outcome mean? You can predict the cost, you can predict the revenue. Remember, these are estimates, and hence your estimated overall cost and estimated overall revenue can possibly change. However, you can estimate reliably what your overall revenue would be, what your overall cost would be. In such a case, contract revenue will be recorded based on the stage of completion using the percentage completion method. So if you look at calculating contract revenue, where cost and revenue for the entire contract can be reliably measured. You recognize revenue on a percentage completion basis. In such a case, your recognition will be revenue which will be recorded based on the stage of completion. Now the problem is, how do you calculate the stage of completion? There are various ways in which you can calculate the stage of completion. We'll come back to this. Stage of completion. One of the best ways to calculate would be the cost incurred upon the total estimated cost. Like for example, if you're constructing a bridge and you have incurred 200 rupees of cost out of the total estimated cost, for example, of 1000, in which case your contract can be said to be 20% complete. Now this is particularly useful in projects like buildings. For example, you might be constructing a 10-floor building. Currently, you have just completed one floor. Someone would say that the project is just 10% complete. Well, probably. However, in a building, you need to dig up that foundation, get that foundation ready, and hence, out of 100 crore cost that you are estimated to incur, 30 crore has been incurred. Bolne ke liye only one floor has been made, but 30 crores of cost because of foundation, etc. has been incurred. In which case, the stage of completion can be 30 crores of cost upon the total estimated 100 crore cost, and hence 30% we can say of the contract has been completed. So when we look at, let us say, your stage of completion can be calculated as the cost incurred till date upon the total estimated cost. Further, while you are calculating the cost incurred, one needs to remember that what all will be going in the cost incurred. Well, whatever is the contract cost incurred, for example, materials consumed, labor, direct expenses, production or construction overheads, whether fixed or variable, all of these will be included as a part of your construction cost. Usually, your administrative costs, selling and distribution costs, they are not directly attributable and hence they will not be included. However, directly attributable construction costs will very well be included. Even while doing that, the idea of doing this calculation is to find the progress, how much has a project progressed. So if there is any unused material which has merely been purchased, that will not go into the cost incurred calculation. Like for example, it is estimated that constructing a building will take 100 crores. You have purchased 20 crores worth of cement and it is lying in your warehouse. Now, bolne ke liye you have spent 20 crores. However, you have not consumed 20 crores. Like in costing, you will see raw materials consumed. You have to consume. You have not yet consumed these raw materials, and as a result, over here, when you look at your cost incurred, it will be based on the materials consumed. So if none of the materials are consumed, you will say that, well, the project has not taken off, it has not progressed. On the other hand, out of the 20 crores of cement that you have bought, 15 crores you have consumed, 5 crores is still lying in your stock, which means your stage of completion is 15 crores. You have actually worked 15 crores divided by total estimated 100 crores, and hence 15% of the project is completed. This 5 crores, which is closing stock of cement in the current year, becomes opening stock in the next year, and in your next year materials consumed calculation, it can be taken. Further, while calculating costs, sometimes the questions will give you adjustment where they will tell you labor cost during the period was 10 crores. However, we have paid only 7 crores. 3 crores remain unpaid. Remember, you are not doing cash system of accounting, you are doing accrual system of accounting. So labor, if they have done work worth 10 crores, the project has progressed to that extent. Now, whether you have paid them now or you are going to pay them in the future, that does not really matter. The stage of completion is based on the work done, and work done is based on the materials consumed, and labor, services rendered. Whether that labor has been paid, not paid, paid in advance, it does not really matter. You are not doing the cash system of accounting, and hence you will get sums where you will have labor which they tell you 7 paid, 3 remaining unpaid. We will say total of 10 has been the labor cost. Like they might have worked in March, you are going to pay them in April, that is in the next year, but they have done work in March whereby the project has progressed, and hence your labor cost which has been incurred during the year should be taken. Materials cost which have been consumed during the year should be taken while calculating the stage of completion. Institute really tests you a lot in this cost incurred calculation. Cost incurred till date upon the total estimated cost. This is one of the most popular ways to calculate the stage of completion. Almost every sum in the institute study material has actually used this method only. However, in certain cases, the other alternative methods like a surveyor would be appointed and they will say what is the stage of completion, or using physical completion method. There may be other methods but not as popular. Stage of completion is usually calculated on a as on date basis and not for the year basis. So if you want to find the stage of completion till the second year, you will take the cost incurred in the first year plus the cost incurred in the second year. That will be the cost incurred till date divided by the total estimated cost. Now you will have to scan through the question to see whether the given cost incurred in the question is the cost incurred for the year or till date. in your stage of completion calculation, we want the cost incurred till date. So if it is for year 1 and year 2 given separately, you will add the two and find the cost incurred till date. If you have directly been given the cost incurred till date, you will take that directly in your calculation. So this is your stage of completion. Let us say it comes to 20%. Now the thing is, contract revenue. How will you recognize the contract revenue? Well, is it necessary that your contract revenue is 1000? No, it may be 1500. Let us say 1000 is the estimated cost. So if it is 1500, we will say 1500 if it is a revenue into 20%, that is the stage of completion, that is 300 should be recognized. Now this is in the first year. Now is it possible that going forward the estimates of total cost possibly change? Is it possible that going forward the estimates of total revenue change? We will do sums on this. However, just for understanding, in year 1, you thought that your entire project will get over in 1000 rupees of cost. One more year goes by, and now by the second year, you now believe that the total estimated cost to complete this project will probably be 1100. Now in the second year, you incurred a further, let us say, 240 crores of cost, in which case your total cost incurred will be 200 plus 240, that is equal to 440 upon 1100. So if I go to say 440 divided by 1100 comes to, in percentage terms, 40%. So a stage of completion, for example, is 40%, that is till the second year. Now the thing is, if I want to recognize a revenue, there is a revenue, let us say, which was earlier estimated to be 1500. Now let us say, due to certain changes, we will study that the revenue estimate also changes. Like there may be an escalation clause. What do you mean by escalation clause? 1500 is not the fixed amount. 1500 had the price over and above that. There were certain escalation clauses, like if there is some inflation, then the buyer will have to compensate the seller for the same, and as a result over here, let us say your revenue estimate changes from 1500 to, let us say, 1800 for example, in which case over here we can say that the revenue to be recognized till the second year, year 2, will be 1800 into 40%. Now 1800 into 40% will, let us say, come to around 720. So that should be the revenue recognized till the second year. However, earlier you have already recorded, I think, 300 worth of revenue in our example. 1500 into 30 into 20%, that is 300. Will I go back and change the last year's revenue recorded? No. You cannot do that, because this is not a change in accounting policy and hence cannot be retrospectively restated. Further, it is not even a prior period item. There is no error on your part. These are estimates, and estimates are judgments and they can very well change. You cannot say that in the last year you did a clerical or mathematical mistake. No. Based on the facts prevailing then, you thought that your overall cost will be 1000. Well, now you think it is 1100. You thought that the revenue will be 1500. Well, now you think it is going to be 1800. Whatever be the reason, over here, let us say, you will calculate revenue to be recognized, and we'll do a lot of practice on this. Revenue to be recognized in the current year is revenue till date less revenue earlier recognized, and hence 720 minus 300, and this will come to, for example, 420. This is the revenue to be recognized till, or so revenue to be recognized for the second year. Till the second year, 720 should have been recognized, out of which 300 has already been recognized, and hence 420 will be recognized. So if I had to calculate the contract profits, there will be contract revenue which is worth 300 in the first year less cost of 200, that is 100, and there will be, for example, 420 in the second year minus, I think you have incurred another 240 of cost in the second year, and hence thereby this would be, let us say, minus 240, I think 180. And let us say, for simplicity, the contract gets completed in the third year. So stage of completion, and you estimated 1100 of cost, actually 1100 hi hota hai. So in the third year, if you go to see, your entire 1800 into 100% should be recorded less earlier recorded, that is 720 in total, and hence 1080 should be the revenue to be recognized in the third year. So this is in year 3, 1080 minus the cost incurred. Let us say you have incurred 440 of cost till date, total 1100 of cost hai, so 1100 minus 440, maybe 660 of cost is incurred, and hence this is just for completion, 420 of further profit to be recorded. If I go to see in totality, 100 plus 180 plus 420, 700 worth of profit which gets recorded over the 3 years. Revenue gets recorded over the 3 years. Basically, if I go to see, your total revenue over the 3 years is 1800. Your total cost over the 3 years is 1100, and your total profit is 700. Now, rather than recording all of this directly in the third year when it gets completed, it is being recorded over the 3 years. Now, this is the beauty of AS7. We will say that what is a big deal? Well, the standard very rarely does it step aside from prudence and conservatism. Ideally, prudence and conservatism would have said that revenue should be recorded when the risk and reward is transferred. Standard says, forget that. You can recognize the risk and reward as and when work is happening, not wait till the time you actually hand over the keys of the project to the buyer. You can recognize the revenue over the period of the contract, and that is a requirement of AS7, which is to be applicable only in case of construction contracts. So over here, in case of construction contracts, in cases where cost and revenue can be reliably estimated, that is the outcome can be measured, revenue is to be recognized on a percentage completion basis, that is revenue till date less revenue earlier recorded, and this is how you will recognize revenue. Now, in rarest of the rare cases, in study material there is just one problem. There may be a possibility that the cost cannot be reliably estimated. जो हमने 1000 या 1100 we said, you cannot reliably estimate it. In which case, the stage of completion, how will you calculate? Well, in the first step, 200 is let us say found, but 200 divided by what? Well, we don't know. The project is such, let's say you have to dig up a mine, you don't know how deep you will have to go to find the minerals, and hence you are unable to determine the cost realistically, in which case the stage of completion cannot be calculated, or there may be a case where revenue cannot be reliably estimated. Like the contract revenue, we believe that the contract revenue is going to be calculated based on the minerals that come out, but I don't know how many minerals are there down. So I cannot reliably estimate, in which case the standard says that in such a case you will not follow the stage of completion method. Instead, you will recognize revenue based on the cost which are incurred and which are expected to be recovered. So if in the first year you have incurred 200 crores of cost, we believe that we will be able to recover that 200 crores, in which case recognize revenue to the extent of cost incurred. So over here, cost or revenue cannot be reliably measured. In such a case, you will recognize the revenue to the extent of cost incurred, assuming that you are able to recover that cost. Now, this is relatively rare. You will not get a question on this. If you do, you should be aware. Most of the questions are on outcome being reliably measured. Okay, next you have a very important point, which is in calculation. Usually, what are the steps that you will follow? Before you go there, a very important point, if a contract has an estimated loss, so let us say your estimated contract revenue is estimated to be, let us say 1500, however your estimated cost is estimated to be 2000, which means there is an unavoidable loss of 500 rupees. So, prudence and conservatism says that if there are profits, you record it as and when there are earned, but if there are losses, you record it immediately. For example, when you look at inventory is valued at lower of cost or NRV. So, if your inventory is 100, NRV is 120, you do not recognize a profit of 20 till the time the sale happens. However, if your NRV is 80 rupees, then you will recognize the loss of 20 rupees immediately. In a similar way, over here, you have taken the project. Now, a question might always be that why am I taking a project where the revenue is only 1500 and the cost is 2000? You are an accountant. Management has taken a decision for whatever reason. Maybe you want to create a track record, whatever be the reason, you have taken this project. In which case, there is an unavoidable loss of 500. In AS29 language, this is called as an onerous or a burdensome contract. The standard says you will create a provision for losses on the onerous contract. You will not wait for the loss to actually happen. In fact, you will create a provision for losses on the onerous contract the moment you realize that the contract has an estimated loss. How will we know this? Sir, in step 1, in every question, if they are asking you to calculate the profit or loss, in every question, your step 1 will be to calculate the estimated profit or estimated loss on an overall basis. That is the total contract revenue estimated minus the total estimated cost. That will give you the estimated profit or estimated loss. If there is an estimated profit, then you don't need to create any provision. However, if there is an estimated loss, like in this case, then you will have to create a provision for the entire amount of loss. However, is it necessary that this estimate remains the same? No, this estimate can possibly change, and hence you will have to reassess the provision at each year. However, if you recognize based on this, there is an estimated loss of 200 or 500 for which you will create a provision. So, if a contract has an estimated loss on a total basis, AS7 requires an entity to create a provision for the entire amount of the estimated loss immediately. This is based on the principles of conservatism that the losses should be recorded immediately, whereas gain should be recorded as and when they are earned. Your entry will be loss to provision for loss, let us say for 500 rupees. Now, in the first year, for example, the stage of completion is calculated still as 200 cost incurred upon the total estimated cost of 2000, and hence your stage of completion is 10%. Remember, your revenue to be recognized is still going to be based on the stage of completion. So that is 10% of 1500, that is 150 rupees. So if I go to year 1, in year 1 my revenue is 150 rupees, my cost is 200, and hence ideally there is a 50 rupee loss. What do you guys think? Will I additionally recorded 50 rupees loss? No, no, no. I've already recorded 500. Out of the 500, 50 rupees which is incurred in the first year is a part of that 500, and hence you will not again record 50 rupees. In fact, that 50 rupees will be adjusted against the provision. There is still remaining 450 rupees in the provision which will be adjusted against future losses as and when they are earned. Your overall loss is 500, would have been ideally recorded over the years. Instead, you have recorded it immediately. And hence, in each of the subsequent years, you will not further record losses. Rather, you will adjust those losses from the provision which has been created. So we will again do sums on this so that you will get clarity. However, on a concept level, one needs to remember that one needs to create a provision for estimated losses the moment the losses are anticipated on the entire contract. So a typical way of solving these sums, follow 4 steps and you will never make a mistake. Step number 1, calculate estimated profit or loss on an overall basis for each of the years. Step number 2, calculate the stage of completion, that is cost incurred upon total estimated cost. Step number 3, calculate the revenue to be recognized, that is revenue till date, which is your total revenue based on the estimate of that year into the stage of completion minus revenue earlier recognized will be the revenue to be recognized for each of the years. And in case a question asks you to calculate contract profit, then in step 4, contract revenue for each year minus the contract cost incurred in each year will give you the profit or loss for each of the respective years. So these are the 2 points best understood with numericals, but at a concept level we just discuss it first and then go on to the sums. Okay. Now, can the estimate of contract revenue or contract cost keep on changing? Well, yes. So the estimated contract revenue or estimated cost may change. What is this? Sir, this is a change in accounting estimate, not a change in policy, and hence there will be no retrospective change. It is not a prior period error because it is a change in estimate. Errors are matter of fact. So if there was a sale of 500 invoice, you forgot recording it, that is an error. Here, there is no error. You thought you will earn 1500, maybe now you think you are going to earn 1800. Now that is a change in estimate, not an error. So these are treated as changes in estimates and will be given effect to when the estimates change. Okay. Now there is another theory point that you need to know, that let us say, how will you record contracts? Will you do stage of completion, provision for losses? Will you do it separately for each contract, or will you combine all of them and do it together? Sir, we don't understand it. Think of it this way. Let us say fixed asset. If a fixed asset is sold, you compare the selling price with the exact WDV of that asset which is sold. You will dig down the invoice, find what is the WDV of that asset sold and find the gain or loss. However, when you look at inventory, you can follow FIFO or weighted average. Like, you will say that what is all the inventories purchased during the year. On an average, what is the average cost? If you follow the weighted average cost method, compare selling price with the weighted average cost and calculate the gain or loss. You have not done it on inventory by inventory basis. You have found that, okay, on an average, what is the case? In a similar way, if I had taken 5 contracts, let us say if I am a builder of dams and from the Himachal Pradesh government, they have a tender offer where I can bid for constructing 5 dams. I bid for the 5 dams. The offer, the Himachal Pradesh government says that you can either bid for all the 5 dams together or none of them. Now, when I do my evaluation, I see 3 of the dams are profitable, 2 of the dams will be a loss. But the profit on the 3 dams is so big that I'm okay constructing the 2 dams also at a loss. In which case, what should I do? Should I account for all the 5 dams separately? The answer is no. Why? Because they are all subjected to a single overall profit margin. The profit on the 3 dams is dependent on the loss of the 2 dams. On the other hand, the Himachal Pradesh government never told me that I have to bid for all the 5 dams. I could have even bid for the 3 dams, 1 dam, 2 dams, whatever. However, in this particular case, the Himachal Pradesh government never told me that. But I bid for the 5 dams, in which case the loss of the last 2 dams has no connection with the profit of the first 3 dams. In which case the loss has, you have to account for each of the dams separately, and if required, you create a provision for losses on the last 2 dams. And the stage of completion will also be calculated for each of the dams separately. I will not find like a weighted average stage of completion. No, that is not correct. Ideally, the default choice is you record each of the dams separately. That is a default choice. However, in case you see that these projects are subjected to a single overall profit margin, in that case, you can combine them and show that as a single contract. So, generally each contract is to be recorded separately. That is a general rule. However, if a group of contracts need to be combined, they can be considered a single contract only if they form a part of a single overall commitment or an overall profit margin. That is, they are negotiated as a single package. Only then will they be treated as a part of a single overall. contract. Okay, next you have this discussion regarding contract revenue. What all should be a part of contract revenue? Obviously, the agreed price should be a part of the contract revenue. Escalation, that is agreed increase in contract price. Generally, to compensate for inflation, you will do sums where there is escalation involved in, let us say, materials, labor, in which case the buyer is agreed to compensate you, in which case that will be a part of your contract revenue. Now, two other important things which are there is performance incentive. Let us say the government wants you to construct the project in time, so they tell you that if you, I'm going to pay you a fixed 100 rupees, perfect. However, if you complete this project within a period of 5 years, I'll pay you another 10, which means the question arises that in the first year, I'll calculate my stage of completion, let's say 20% into, should I take the total contract revenue as 100 or should I take it as 110? Should I include the performance incentives in my contract revenue? If you look at prudence and conservatism, they say that ideally you should not be including these in your total contract revenue because we are not sure whether you are going to earn that or not. Now, over here, the question will trap you. They will try to tell you that based on past experience, we are reasonably certain that we will complete this within 4 years. However, remember, your earning over here should not be dependent on past performance, but based on this project. Not to kind of demotivate you or anything. However, let us say in your past experience, in your foundation or in your 11th, 12th, 10th, you have always scored in 70s, 80s and 90s. Does that mean in CA Inter and CA Final we will do that? No. Because every project is different. That does not really mean that merely because in the past you have scored a 90%, well, I pray that you score 90% here, but that does not necessarily mean that you will do that. And hence the standard says performance incentives can be recognized only if the project is at a sufficiently advanced stage. Now you are just 20% complete here. Sufficiently advanced is more than 90% complete. The project has to be in a sufficiently advanced stage and it should be virtually certain that you receive the incentives. Only then can you recognize these performance incentives. So performance incentives will be only included if the process is a sufficiently advanced stage and it is virtually certain that the incentives will be received. Otherwise, you will not include it. So in the last year, if you actually earn the incentives, then in the last year your contract revenue will be included because of the performance incentives, but not before. Variation in scope. Earlier, you had a 100 crore contract to build a 50 kilometers road, which is a 2-lane highway. After a few months or years, we agree that it should be a 4-lane highway, not a 2-lane highway. In which case, is there a variation? Well, yes. Will you still construct at the same value? No. Maybe you are going to charge more because you will have to incur more cost. But if the variation is agreed between the customer and the entity, then the increased revenue, increased or decreased revenue, and the increase and decrease cost should be taken into the contract cost accounting. So variation in scope, if the variation is agreed by the customer and the contractor, that should also be a part of your overall contract revenue, or any claims or reimbursements that have been agreed separately as well. So over here, these 4 items, agreed price should be there, variation in scope if agreed, performance incentives if the contract is at a sufficiently advanced stage, and escalations or any other reimbursements that the buyer is going to give to the seller will be considered as a part of your overall contract revenue. We will do a sum which is entirely pertaining to the contract revenue specifically. Then we discussed about contract cost earlier as well. This will include direct material, direct labor, direct expenses, production overheads which are directly attributable, whether it is fixed or variable, but it will not include general selling or distribution overheads which are not directly attributable. It will not include materials which are not consumed. It will not be included over here. Labor cost will be included to the extent it is incurred, irrespective of whether it is paid or not. And last, in terms of disclosure, if it is specifically asked, and there have been rarely 1 or 2 questions where this has come, if a disclosure is specifically asked, then you need to disclose what? Contract revenue, stage of completion, contract cost, contract profit, all of these, what you have calculated has to be separately disclosed, maybe in the notes. Now, there are a few new terms that you should be aware of. First, there's progress billings. What does a progress billing mean? It means how much have I billed to my customer. It is like saying that if I appoint someone to paint my house, they charge me a 50% advance. Now, they have not even started doing the work. As per AS7, revenue will be recognized based on the stage of completion. Now, they have not even started painting. However, they have raised a bill on me and demanded 50% advance. That is progress billings. So, progress billings, these are bills raised by the contractor on the customer irrespective of whether the money is received or not. These are bills raised. For 100 rupee contract, 50 rupees ka bill raise kar diya, progress billings are 50. I want to tell my reader ke bhai, theek hai, this may be the stage of completion, this may be the revenue, but this is a bill that I have raised to my customer. Now, on that bill of 50 rupees, the customer may pay me the entire 50, or the customer may pay me only 45. They may retain 10%. And they might say, भले तुमने bill raise किया 50 का, I will pay you only 45. Remaining 5 I will pay you later when the project is completed. These are called as retentions. Retentions means progress billings which remain unpaid. 50 में से 45 is collected, 5 is unpaid, also called as retentions. In case the question asks you, relatively lesser chance. And then there is this problem of gross amount due or from the customer. Now how do I calculate it? Ideally my gross amount due from or to the customer should directly be compared by comparing the contract revenue. Let us say the contract revenue was 90, in which case my journal entry would have been debtor account debit to sales or contract revenue 90 rupees. So that should have been my receivable. However, I have raised the bill. Now this 90 is based on the stage of completion. I have raised a bill of 150 rupees. That means for work worth 90 which is done, I have raised a bill of 150. That means 60 rupees that I have received is advance that I have already received from the customer, additional advance. Or I have done a billing of only 40 rupees, then 90 minus 40, that is money that is yet to be received from the customer. Now how do I calculate this? Instead of taking contract revenue, I take contract cost plus profit here, but cost plus profit is the revenue, or cost minus losses. Ideally would have been revenue. However, over here sometimes losses may be recorded on the entire contract. So rather than recording contract revenue directly, they say contract cost plus profit, but here cost plus profit is the selling price usually, or cost minus loss. Again, cost minus loss will also be the selling price usually. However, in this case sometimes it might happen that you have to record the entire losses, and hence they say that you, instead of recording contract revenue directly, you take the contract cost plus profit minus losses. Sir, why? Because losses are not going to be recovered from the customer. If the cost is 2000, revenue is 1500, 500 of cost you have to bear. So merely because you have incurred cost does not mean customer is going to pay you for that. That is a loss that you have to bear. Beyond that loss, you can recover money from the customer. Minus the progress billings which have been paid or unpaid will give you the gross amount due to or from the customer. There is only one sum, I think, of an earlier attempt where this calculation is done. If you are comfortable with this, great. Otherwise, just remember these 2-3 things: progress billings, retentions, as well as gross amount due or from the customer. We will do a couple of problems on this concept as well, but otherwise institute usually does not test you a lot on these disclosures per se. So this kind of takes care of AS7 concept side. On the other side, we will go to the discussion of important questions and overall review of your AS7 on the numerical side, which will strengthen and make you foolproof on the concepts over here. So let us say we go to the questions over here. Over here we are at AS7 now. So we will go on to the questions here. There are close to 19 odd questions, out of which I would say maybe around 6 or 7 are repeated, almost similar questions, and hence we will kind of quickly discuss them, and other all questions also we will kind of solve. So let us get started. The last day revision questions I have kept at the beginning, so you can review them, mark them for the last day revision purposes. We will discuss all of them. Go to question number 1. On 1st December, Vishwakarma Construction undertook a contract to construct a building for 85 lakhs. That is your contract revenue. On 31st March 17, the company found that it had already spent 64,99,000 on the construction, and prudent estimates of additional cost for completion was 32.01, which means if I look at the total estimated cost, 64.99 plus 32.01 should ideally come to around 97 lakhs. The selling price is 85 lakhs, and hence there seems to be an estimated loss of 12 lakhs for which I need to create an immediate provision. What amount should be charged to the revenue in the accounts for the year ended 31st March 17 as per AS7? So if I am just asked the revenue, I will first figure out, usually my steps are, if profit is to be asked, the 4 steps I will follow is: first, determine if there is an estimated profit or loss. In this case there is a loss, so mention that there is a provision. Second step, find the stage of completion, that is cost incurred upon total estimated cost. Third step would be to calculate revenue as stage of completion into the total contract revenue minus revenue earlier recognized, and last, contract revenue recognized minus the cost for the year will give you the profit. These are the 4 steps. Here you are just asked to find the revenue, so you can even do it directly, where you can find the stage of completion as 64.99 divided by 97. So that comes to probably in percentage comes to around 67%, and your revenue to be recognized will be 85 lakhs into 67% comes to how much? around 56.95. That's about it. If the question had asked you how much of the profit or loss has to be recorded, we would have said that the entire loss of 12 lakhs has to be recorded in this year. So this is around 56.95 lakhs, question number 1. Next, you go to question number 2. Uday Constructions undertook construction of a bridge for the government of Uttar Pradesh. The construction commenced during the year 31st March 16 and is likely to be completed in the next year. The contract is for a fixed price of 12 crores with an escalation clause. So this is your transaction price or your contract revenue. This is for 12 crores with an escalation clause. The cost to complete the whole contract is estimated to be 9.5 crores, which means a project is profitable. 12 minus 9.5, that's a 2.5 crore profit. You are given the following information for the year ended 31st March 16. Cost incurred up to 31st March is 4. Cost estimated to complete the contract is 6, which means if you want to find your stage of completion, this is 4 upon 6 plus 4, that is equal to 40% will be your stage of completion. The escalation, this is the important line over here, the escalation is 5%, and according to the contract, the price increases, let us say, by 5%, which means by the end of the year, you expect that there is an escalation, and hence the total contract price instead of 12 will now be 12.6 crores. Remember, your cost, which was earlier 9.5, is now 4 plus 6, that is equal to 10, and hence the escalation is already factored into the cost. You are required to identify the stage of completion, sir, 40%, and calculate the revenue. So revenue over here will be 12.6 into 40%. 12.6 into 40% comes to around 5.04. This comes to 5.04, and profit to be recognized. Well, profit will be 5.04 minus a cost of 4, and as 1.04 will be the profit amount. So if I go to see, yes, 1.04, 5.04 minus 4. Perfect. Now question number 3 is a simple question, but I would mark this for last day revision because it is a very typical question that the institute asks on separation versus combining. The general rule that you have studied is you should ideally record the contract separately unless they are a part of a single package subjected to a single overall profit margin. That is, you cannot do one without the others. GTI negotiates with Bharat Oil Corporation for construction of retail petrol and diesel outlet stations. Based on the proposal submitted to different regional offices or BOCL, the final approval for one outlet in each region X, Y and Z is awarded to GTI. So by the way, I had applied for various outlets, probably independently, out of which I got approval for one outlet in each of the 3 regions. A single agreement is entered between the two. The agreement lays down that each of the 3 outlets are for these prices. Agreement lays down the completion time for each region. So this seems to be independent. Whether GTI will treat it as a single contract or 3 separate contracts. Well, if the question had anyway told us that it is necessary for us to either take all the 3 contracts or none of them, then we will take it as a single contract. Here nothing of that sort is mentioned. A student might say that, sir, but it is a single contract. So be it. Let it be a single contract. Even if it is a single contract, we would consider this to be a part of a 3 independent contractual arrangements, because I cannot say contract 2 is dependent on contract 1. Even if there was no first contract, I would still have obtained a second contract, and hence we should account stage of completion, provision for losses, etc. for all of them separately. Okay, then you have question number 4. This is on a very specific case which is pertaining. So let's review. Sarita Construction Company obtained, this is good for last day revision, obtained a contract for construction of a dam. The following details are available from the records of the company for the year ended 31st March 2018. So if the total contract price, work certified, that is work done for which a certificate is obtained, 6250, work not certified, work done for which no certificate is obtained. Like you have constructed a 5.5 floors, architect gives you a certificate for 5 floors. For the half floor, architect does not give you certificate, but you have done work and cost is incurred. Okay, an estimated further cost to complete, which means your cost incurred till date would be 7,500. Certified plus uncertified, and further cost is 8750, which means your total estimated cost will probably be around 16,250. Progress payments received, that is billings that you have done for which money is received, and progress payments yet to be received. So basically, if I go to see, the total billings that I have done is 7,000, out of which 5,500 I have received, remaining 1,500 I am yet to receive. Applying the provisions of AS7, you are required to calculate the profit or loss for the year ended 31st March 18. Step number 1 is you calculate the estimated contract revenue, which is 12,000, compare it with the total estimated contract cost, which is 16,250, and hence there is a 4250 estimated loss. And if there is a 4250 estimated loss, the entire loss, irrespective of the stage of completion, will be recorded in the first year itself. Contract work in progress at the end of the year. Work in progress is calculated based on the cost incurred. The project is not complete and hence it is still work in progress, but work in progress is calculated based on cost incurred, irrespective of how much cost is yet to be incurred and irrespective of the fact that whether the cost incurred has been certified or not, and hence this will be 6250 plus 1250, which is equal to 7500, which will be the contract work in progress. Point 3 is the revenue to be recognized out of the total contract value. Well, this has to be based on the stage of completion. Stage of completion will be 7500, cost incurred about 16250, and hence 7500 upon 16250 in percentage comes to 46.15%. So the revenue to be recognized, because it is the first year, would be 12,000 into 46.15% comes to 12,000 into 46.15% comes to 5538. So this comes to, let us say, 5538. Amount due from or to the customers at the year end. So you will try to find the amount due from or to the customers. Now this is a very specific term. Institute earlier used to ask it, these days they are not asking. But how do you calculate the amount due from or to the customer? You calculate it as a cost incurred. Your cost incurred would be 7500 plus profits if any. In this case there is no profit, minus losses. And losses are 4250. Remember, these 4250 losses are already recognized, and from the customer you might incur total 7500 and then 16250 of cost, but you cannot recover losses from the customer. Maximum you can recover 12,000. So you are removing the losses. You can't recover that from the customer. But how much have I done? Progress billings. Well, 7,000. No, money received is only 5,500. We are going to subtract the progress billings over here, and hence this is 7,500 minus 4250 minus 7,000, and this comes to 3750. This is the amount due to the customer, because for something which is 7,500 minus 4250, you have actually built up to 7,000, and hence 3,750 is the amount due to the customer if it comes. This is in question number 4. Okay, then you have question number 5, which is similar to question 19. So what we will do is we will jump up to question number 19, do that, and then come back to, let us say, question number 5 once. So let us review question number 19. Has a few more interesting adjustments. RT Enterprises has entered into a fixed price contract for construction of a tower with the customer. The initial tender price is 220 crores. At the start of the contract, it is estimated the total cost will be 200 crores. So at year 0, there is no estimated loss. 20 crores is the estimated profit. So this is 220 minus 200, that is equal to 20. At the end of year 1, this estimate stands revised to 202 crores. So the cost estimate is revised to 202 crores. If nothing is given, your revenue continues to be 220 only. So still there is an estimated profit. Thereby you don't really need to prepare a separate loss provision. Assume that the construction is expected to be completed in 3 years. During year 2, the customer requests for a variation in the contract, and as a result, the total contract value increases by 5 crores and cost increases by 3 crores. So assuming that the variation is accepted, your total contract value increases by 5 crores. So this becomes 225 and cost increases by another 3 crores. So 202 plus 3, that comes to 205. And hence the contract is still making a profit. If nothing is given in year 3 as well, this is the same condition to prevail. RTS decided to measure the stage of completion on the basis of proportion of the contract cost incurred to the total estimated cost. Contract cost incurred, what is given? Contract cost incurred at the end of each year. So this is cost incurred till date, not for the year. Is 52.52, 154.2 including unused materials of 2.5, and then 205. You expected a total cost of 205. Actually 205 is the cost in the third year total. This is till date, not for the year. You are required to find the stage of completion for each year. So if I go to year 1, this is total cost incurred 52.52 divided by, I think, 202, which is your total estimated cost 52.52 upon 202 comes to, I think, 26%. When you go to the second year, your cost incurred in total is 154. This is till date minus 2.5. So this is 154.2 minus 2.5 because there are unused materials. So this is 151.7 upon, I am expecting 205. So upon 205 in percentage comes to 74. And last year 205 by 205. So the entire 100% is completed in the last. You are required to calculate the profit to be recognized in each year. Now, how do you calculate a profit? A standard template is, you will find the revenue which is to be recognized till date less revenue which was earlier recognized, and hence this will give you revenue to be recognized in the current year minus the cost incurred in the current year, and that will give you the profits. So when I look at the revenue till date, in the first instant I would say that the revenue to be recognized till date would be 220 into 26%, second year 225 into 74%, and last year my entire 225. So this is 220 into 26% comes to 57.2 less earlier recorded nil. So this is 57.2 minus cost incurred of 52.52, and hence you will get a profit of around 4.68 in the first year. When you go to the second year, you will have 225 now into 74%. This is 166.5 less cost revenue earlier recognized is 57.2, and hence you get 109.3 less earlier recorded you will get, and the cost incurred in the second year, well, I'll have to calculate it. Well, 151.7 is the total cost incurred, out of which 52.52 was in the first year. So 151.7 minus 52.52 comes to around 99.18, and hence if I subtract this, 109.3 comes to around 10.12, and lastly 225 minus earlier recorded, this is 166.5. So this is 225 minus 166.5 comes to around 58.5 less whatever is the cost is 205 total minus 151.7 earlier recorded, 205 minus 151.7 comes to around 53.33 or 3, and hence you get what? You will get, I think, 5.2. Ideally, if I total up all of this, I should get my contract profit that I am estimating total, that is around 25 minus 205, that is 20. So this is 4.68 plus 10.12 plus 5.2, and there you go, 20 rupees. So this is regarding question number 19. I would say this is important for last day revision. A similar question is there earlier, which is question number 5. You will see almost similar data, just that they have arranged it properly in a tabular format. यहाँ पे सिर्फ there's one additional adjustment for that unused inventory which was unutilized in the second year. Here they have separately said that it will be utilized in the third year. Even in question 19 that is the case. However, in question 19 if nothing is given, we'll assume that 205 is all inclusive of all the costs incurred. However, when you see over here, construction contract has a price of 9,000 lakhs for 3 years, summary initial amount. Then you have some variation which you should have separately added, it is added, and contract cost incurred. You will just highlight this part, which is 6168 and 8100. 6168 includes 100 for material stored to be used in year 3 to complete the work, and hence you will have to remove this 100 from here, and then it says in the next part excludes 100 of material brought from year 2, which means this 8100 is not including material that was from year 2 and utilized in year 3, so I'll have to separately add it, and that's it. Otherwise it is exactly the same. You can practice this, you can pause and practice question number 5, and if you get this correct, most of your AS7 complex questions you should be able to address. Same is the case with question number 6. This is similar to question 4. You can just pause and try this question 6. You will see exactly same data, where you have to find, let us say, using this work certified, uncertified data, the profit or loss to be recorded, revenue to be recorded, etc. Try to pause and solve. You should be getting question 6 correct as well. Next, you go to question number 7. Now, this is a case-based questions on performance incentive, which institute likes asking. Sky belongs to the heavy engineering contractor specialized in construction of flyovers. The company just entered into a contract with a local municipal corporation to build a flyover. No activity has started on the contract. Okay. As per the terms of the contract, Sky will receive an additional 50 lakhs if the construction of flyover were to be finished within a period of 2 years. That is a performance incentive which will be recorded only if the project is at a sufficiently advanced stage and it is virtually certain that you will receive it. Here, no activity has started on the project. So, let alone sufficiently advanced stage, no activity has started on the project. The accountant of the entity wants to recognize this revenue since in the past the company has been able to meet similar targets very easily. Give your opinion on this treatment. In this case, the past experience does not matter. Your project has to be sufficiently advanced, which is not, and hence 50 lakhs not considered in project revenue calculation till the time the project is at a sufficiently advanced stage. If it is at a sufficiently advanced stage, that is 90-95% complete, then you can add it, but not currently. That is question 7. Now 8 and 9 are similar. Now 8 is very similar to question 3, where you will have a commercial complex which has 3 separate units. For each of the units price is 50, 60, 70. Should you treat it as a single or separate? We have done it exactly. This is the same thing over here. We say that because they are not dependent on each other, we will show them separate. Question number 9 is similar to that flyover that you constructed, where you are going to get a performance incentive. Again, you just entered a contract with the municipality. You are going to receive additional 2 crores if it is finished in 2 years. X wants to recognize this revenue. We will say that no, that is not correct, because you have not, the project is not at a sufficiently advanced stage. Your past experience does not matter. So 8 and 9 is kind of a repeated question, more for your practice. Next you go to question number 10, which we have marked for last day revision. It's a good question. There is too much data given over here. You have to cull out and take only the relevant data. The question is easy. It's an exam question, but there's a little bit of data overload over here. Now Rajendra took a contract for 20 lakhs on an arrangement that 80% of the value of the work done as certified by the architect should be paid immediately, and the remaining 20% retained till the contract was completed. Now these are payment terms. If you are asked to prepare a customer account, in which case how much money is received is irrelevant. Remember, whether you receive 80% of the money, full money, or zero money, revenue recognized is based on the stage of completion. So all of this data which is given, that how much percentage of the work is certified, of that how much money is received, that is all given to throw you off track. In year 1, the amounts expended were 8 lakh 60, that is money spent. The work certified was for 8 lakhs. So 60,000 ka you not got certificate, but basically 8 lakh 60 is your cost incurred. 80% of this was paid as agreed. It was estimated that the future expenditure to complete the contract would be 10 lakhs. So your total estimated cost would be 8 lakh 60 plus 10 lakhs, that is 18 lakh 60. Compared with 20 lakhs, the project is profitable, no provision is needed. In year 2, the amounts expended were 475. This is in year 2, not till date. This is in year 2, so additional 475. And 3/4 of the work under contract was certified by 31st December, and 80% of this was received. It was estimated that the future expenditure to complete the contract will be 4 lakhs. Now how will you find the total estimated cost? Well, you will say 8.6 was in the first year, 4.75 in the second year. So that is your cost incurred plus remaining cost of 4. So 8.6 plus 4.75 plus 4, and this is 17.35. Still my contract revenue is 20 lakhs. The contract is profitable. In year 3, the amounts expended were 3 lakh 10. And on 30th June, the whole contract was complete. So basically cost incurred is 8.6 plus 4.75 plus 3.1. So over here, you will have, I think, 16.45 of total cost, and the contract is still profitable. Show how the contract revenue would be recognized in the P&L of Mr. Rajendra. That's it. You are just asked to calculate the contract revenue. And when you are doing the contract revenue, you first see the contract is profitable, then you calculate the stage of completion in year 1, 2 and 3. You do the workings on a till date basis, where you say in the first year 8.6, let the certificate come for whatever amount. You have spent 8.6 out of the total 18.6. So this is 8.6 out of 18.6 in percentage comes to, I think, 46.24%. Next, your cost incurred is 8.6 plus 4.75, that is 13.35 upon 17.35. That is your total estimated cost, comes to around 76.95. And last year, your total cost is 16.45 upon 16.45, and hence the contract we can say is 100% completed. So over here, this is contract 100% completed. Stage of completion is 46.24. So your revenue to be recognized in each year, this will be 20 lakhs into 46.24% comes to around 9 lakh in the first year. If I take into 20 lakhs, this is 9 lakh, 24,800. When I do into 20 lakhs for the second year, this is 20 lakhs into 76.95% comes to around 15 lakh, 39,000, out of which earlier recorded was 924,800, and hence minus 924,800 comes to around 6 lakh, 14,200, and so on will you do the working for the second year and the third year. So this is 6 lakh 14,200. In the last year, the entire revenue of 20 lakhs minus whatever was to be earlier recorded, 461. Okay, so this is question number 10. Then is question number 11, again an exam question. This is largely a question which pertains to contract cost. We can put this for last day preparation also. A similar but a slightly more advanced problem will also come, I think question number 18 or so we will discuss that as well alongside. There will be one additional adjustment there, both you can refer. The following data is provided for Messrs Raj Construction. Contract price is 85 lakhs. Perfect. Material uses 21 lakhs, out of which material costing 4 lakhs is still lying unused. That means 21 minus 4, that is equal to 17 lakhs, is going to be a part of your cost incurred. Okay, labor expenses were 16 lakhs, out of which 1 lakh is still unpaid. So what? Labor has done a work which is up to 16 lakhs and hence 16 lakhs will be taken as a part of your cost. Specific contract cost directly attributable you will take. Subcontracting cost is 7 lakhs. This also you will take. Subcontracting means you have appointed like an agent to do some of the work. He has done work of 7 lakhs. Advance paid to them is 4 lakhs. Again, this does not matter whether you paid 4, 40, 14, 0. Work done is to the extent of 7 lakhs. Further cost estimated to be incurred to complete the contract is 35 lakhs. This is additional cost. You are required to calculate the percentage completion, that is based on the cost incurred upon total estimated cost. So your cost incurred is 17 plus 16 plus 5 plus 7. So this comes to what? 17 and 16 and 5 and 7 comes to 45 upon 45 plus 35. I think this comes to 80. 45 by 80 in percentage comes to I think 56.25. This is your stage of completion. Contract revenue to be recognized, well, 85 lakhs into 56.25% comes to how much? Well, 47 point something, 47 point, let's say 81 or 82. And the cost to be recognized, well, cost to be recognized is going to be 45 and the difference is going to be profits. So if I go to see, this is your stage of completion, 56.25, 47.81 or 82 and contract cost of 45 to be recorded. Question 12 is again similar to question 3 where there are multiple projects. You are constructing an industrial complex. Once there was a bridge, once there was a dam, once there was a commercial complex. It has separate proposals very clearly given. Each unit is subject to separate negotiation. In which case should you treat as a separate contract? Yes, this will be a separate contract. Okay, then you go to question number 13. This is a good question pertaining to contract revenue. There are quite a few interesting adjustments over here to find the contract revenue. We can do it for each of the years. Institute has done it directly for the third year final revenue. We can actually show the working of estimate for each of the years in my opinion. Now AB contractors enters into a contract on 1st January with XY to construct a 5-storied building. Under the contract, AB is required to complete the construction in 3 years, that is by 31st December 13. And the following is relevant. The fixed contract price is 5 crores. Perfect. Should that be taken? Yes. Material cost escalation to the extent of 20% of increase in material cost. So whatever is the increase in material cost to the extent of 20%. Labor cost escalation up to 30% of increase in minimum wages. Whatever is the increase in minimum wages, 30% of that. In case ABC is able to complete the construction contract in less than 2 years and 10 months, it will be entitled to an additional incentive of 50 lakhs. But you will only take it once you actually complete. However, in case the construction is delayed beyond 3 years and 2 months, XY will charge a penalty of 20 lakhs. Okay, so it's both sides. At the start of the contract, AB has reason to believe that the construction will complete by 2 years and 8 months and hence you will get an incentive of 50 lakhs, but I will not take it till the time incentive is actually received. Assume that the construction was actually completed in 2 years and 9 months, which means, are you entitled? Yes, it is within 2 years and 10 months and hence in year 3, we will take the 50 lakhs as a part of our revenue. In year 1 and 2, this will not be taken. Labor cost was originally estimated to be 1.2 crores based on initial minimum wages. However, the cost have increased by 25% during the construction period. Achha, are you going to get any compensation? Well, yes. The question is labor cost escalation up to 30% of increase. Now, you are getting a compensation up to 30% of increase, but the increase is not 30%. If the increase is 25%, you will get compensation based on 25% only. So, 1.2 crores into 25%. बोलने के लिए one can say increases to be compensated up to 30%. Up to 30 है. Actual increase is 25, so you will get up to 25% only. So this is 1.2 into 25% comes to I think 0.3. This is also what I'm going to get from the customer, and hence it will be a part of my revenue. Next, material cost have increased by 40%. Here you are going to get reimbursement to the extent of 20% only. They have increased by 40%. Due to short supply, the increase in material cost due to the 40% escalation is 80 lakhs. Now 80 lakhs is directly the increase. So if I go to see 80 lakhs or 0.8 crores is due to a 40% increase, you are going to getting compensation only up to 20%. That is equal to how much? So if I do a cross multiplication, you will possibly get around 0.4 of the escalation, which is 80 lakhs, which is increase. 40 lakhs you will get from the customer. You are required to suggest what should be the contract revenue in the above case. So in the above case, if I go to see, if I am doing the workings for year 1, year 2, year 3, well, I will take the fixed contract price of 5 crores everywhere, unless given otherwise, labor cost of 0.3, 0.3, 0.3 and material cost I think of 0.2. But when I go to the last year, performance incentive of 50 lakhs will also be taken. So if I go to see, this is what? I think 5.5, 5.5 and approximately 6 if I am not wrong. 0.3, this is 0.4, sorry, not 0.4, not 0.2, my bad. So these numbers would be different. So this is 0.4 for materials. Institute has directly taken the final contract revenue only. Over here we are just doing a slightly longer working. This is 5.7, 5.7 and 6.2. Acha, assume that in the year 2012, that is in the second year, XY has requested AB to increase the scope of the work. An additional floor is required to be constructed and there is an increase in the contract fee by 1 crore. But that is in the second year. So there will be no impact in the first year for this. AB has also incurred a cost of 20 lakhs for getting the local authority approvals, which it is entitled to claim from XYZ in addition to the fixed fee. So over here, measure the contract revenue in such a case. In such a case, in the second year, you will add 1 crore and also 0.2 crores because you can claim that reimbursement. Same is also going to be considered in the third year, and as a result, if I had to find the total estimated revenue, in the first year it will be 5.7. In the second year, probably this will be what? 5.7 plus 1 plus 0.2 comes to around 6.9, and in the last year, it will come to around 7.4. ICAI has directly taken the final contracted revenue 7.4 and 6.2. In the first case, 6.2 and 7.4. Though if I have to do the journey for the other years as well, we have shown how it will be done for the other years. An interesting question. Next, you will go to question number 14. Over here, X has commenced construction contract on 1st April 11. The fixed contract price was agreed at 2 lakhs. Perfect. Company has incurred 81,000 in the year 11-12 for 45% of the work. So if 81,000 is for 45%, then total cost estimated may be 1 lakh 80 if you want to know. But 45% you have been clearly mentioned is the work done, and received 79,000 as progress payments from the customer. Now whatever you receive, for stage of completion it does not matter. If a customer account is asked, then probably it does matter. The cost incurred in the year 12-13 was 89,000 to complete the rest of the work. Achha, in the first year we incurred how much cost? Sir, we incurred 81. You might have received 79, but we incurred 81. In the second year you incurred how much? Sir, 89. So you incurred a total cost of 81 plus 89, that comes to 1 lakh 70 for earning a 2 lakh revenue. Again, this is a profitable contract. Show the extract of the profit and loss. Achha, you have to show the extract of the profit and loss, not just a statement. And the customer's account. This is the new part. So when you are revising, I would not really put the entire thing for last day revision, but customer's account was not asked in any other question. It is asked over here for the related years. So if I want to find the profit and loss, I need to find the stage of completion in year 1, which is given to me as 45%. This is given. And in year 2, the entire contract is completed. So this is 100%. So if I want to find the revenue, 45% of 2 lakhs, that is 200,000, that comes to what? 90. And 100%, this is equal to 200 minus 90, so 110. So this is your contract revenue. Cost to be incurred is 81 in the first year, 89 in the second year. So this is 90 in the first year, 81 is the cost, 9 is the profit. In the second year, 110 is the revenue, 89 is the cost, 21 is the profit. You just have to prepare it in the P&L format. You can even do it vertically or horizontally. ICI has done it horizontally. Now the thing is customer's account. In your customer account, it is like the debtor account. So in debtors, what is your entry? The moment there is a sale, your entry is debtor account debit 2 sales. In year 1, your debtor account debit, let's say this is customer or debtor account debit 2 sales. So your contract revenue would be recognized at 90. But by bank, you have collected money. How much? 79, and hence 11 is the closing balance, which becomes the opening balance of the next year, and a further 110 is recorded as sales. Unless given otherwise, we assume the entire 121 is collected in cash. So over here, there's a balance carried down of 11 that should be there over here, and other than that, the entire money is collected. Now question 15 is not a difficult question, it is just question pertaining to a special case where outcome of the project is not reliably determinable. We have studied that wherever the outcome is not reliably determinable, if the question tells you that there are uncertainties, then you will recognize revenue only to the extent of cost. So PQ and Associates undertakes a construction contract, the details are provided below. Contract value is 40, cost incurred to date is 3, estimated future cost is 30, and work completed is 10%, very clearly given to you. Actually, if the question ended over here, we would have said 40 into 10%, that is 4, is the revenue to be recognized, minus 3, and hence 1 will be the profit. However, the question tells you over here, the work has started some time ago and there is uncertainty in respect of outcome of the contract due to changes in regulations, very clearly telling you that. Now, in such a situation, PQ is certain that it would be able to recover the cost incurred till date, in which case how much is the revenue to be recognized? Well, to the extent, so you will not recognize 40% into 10, that is 4, you will record it to the extent of cost, that is equal to 3. So this is 3 minus 3, which is equal to nil. Okay, then you have question number 16. This is the only question that you will study where you have a cost plus contract. Usually every contract is a fixed contract. In this case, the contract over here is a cost plus contract. So in a cost plus contract, your revenue, you really don't have to bother about the stage of completion, because whatever is the cost incurred which is agreed to be reimbursed plus the profit margin will be your revenue. Remember, all costs need not necessarily be agreed to be reimbursed. Like they have agreed to reimburse you an economy class ticket, you fly business class. So that additional amount you are not going to get compensation, and hence your cost incurred will include the total cost incurred. However, your contract revenue will be the reimbursable cost plus the profit margin. However, if in the future you are expecting that there will be further non-reimbursable cost, it is like provision for losses. You know that there is going to be certain costs which you will not be able to recover, then the standard says you create a provision for the same. So I would even put this in as an LDR question. It is not specifically written, but let's add it because this is the only case where there is a cost plus contract and adjustment done for the same. Now X Limited commenced construction of a contract on 1st April 11. The contract price was reimbursable cost plus 10%. This is your contract price. The company incurred 1 lakh in the year 11-12. So this will go in my PNL, of which 90,000 is reimbursable, 10,000 is not, but my entire cost of 1 lakh will go in my PNL. So the revenue kitna hoga? Well, revenue will be the reimbursable cost, that is 90,000 plus 10%, that is equal to 99,000. So my total cost is 1 lakh, my contract revenue is 99,000. Now this is the interesting adjustment. The further non-reimbursable cost to be incurred to complete the contract are estimated to be 5,000. Now, reimbursable costs may be incurred in the future. In the future, when they are incurred, you will record it, and Samni will record the revenue as well. However, non-reimbursable costs, no matter what happens in the future, you are not going to get reimbursement, and hence, ideally for this, as per ICI solutions, you will create a provision for losses of this 5. The other cost to complete the contract could not be reliably estimated. Even if they could have been estimated, you would not have recorded reimbursable cost, because against that reimbursable cost you will get a revenue, but for non-reimbursable cost you get nothing, and hence provision for loss is to be created separately for 5 lakhs, and hence a net loss of 6 is to be recorded. Next you go to question number 17. Show the profit and loss extract in the books of a contractor in respect of the following data. So contract price, cost incurred till date, estimated cost to complete. So if I total both of these, I think this is 650, which means there's a 50 rupee loss. So you'll have to create a provision for estimated loss to the extent of 50 rupees. Assume that the contract period is 2 years and the contract is 100% complete by the 2nd year. Okay, actual cost incurred is the same as the total estimated cost. So that's perfect. So if I want to calculate in my first year, I have to prepare extract of P&L account. So if I have to calculate the profit and loss, let us say in the first year, I will say what is the contract cost incurred, sir, 390, into what is the revenue that is to be recorded. Well, that is based on the stage of completion, that is 390 divided by 650. So 390 by 650 comes to I think 60%. So revenue will be recorded as 600 into 60%, that comes to 360. Now the thing is, you should have created a provision. Now there are two ways in which you can solve, both of them will give you the same answer. Losses account debit to provision for losses. So let us say you must have created a provision of entire 50. Well, because the entire loss of the project you have to record, but in the first year 360 minus 390, 30 of loss is getting recorded. Will that loss further go to P&L? Because if you do nothing, your balancing figure will show a net loss of 80, but is the net loss correctly 80? No. And hence what will we do? We will adjust the 30 of loss against the provision. Like bad debts, you create a provision for bad debts, but when the actual bad debts happen, you adjust it against the provision for bad debts. In a similar way, you created a provision for losses, but when the actual losses happen, you will adjust it against the provision. So over here, this is, let us say, against the provision for losses. This provision for losses are, for example, 30 in the current year, and hence your balancing figure, if you now set to calculate, we are saying that your provision was created for 50, out of which 30 was realized in the current year, 20 is yet to be realized, will be recorded or reversed in the next year. So you can either create a provision of 50 and then reverse 30 out of it in the first year, or rather than doing it, what the institute does is, rather than creating a provision of 50, reversing another 20, by the end of the year you will create a provision of only foreseeable required loss in the future, that is 20, in which case your net loss still appears to be 50. Basically at the end of the year, in the first year 50 should go. Now when you go to the P&L of the second year, in the second year further cost incurred are 260. Now maybe out of 60% project is complete, 40% is remaining. So the remaining revenue you can calculate as 600 minus 360, that is equal to 240 of revenue to be recognized, and hence a further 20 of loss is to be recorded. However, you have already created a provision. I can't take it to net loss in the P&L of the second year. You have already created a provision. So what will you do? You will reverse the provision. Your provision has a balance of 20, you will reverse it, and as a result there will be no further net loss recorded. But sir, there is a loss, but that is already been recorded, entire 50 in the first year, 30 and 20 both, and hence in the second year when the loss actually materializes, you adjust it from the provision rather than taking it to the P&L. So this is why we have this adjustment is the crux, I would say, over here. Provision for loss for 20 and then reversal of this provision for 20 is something that you have to revise. Okay. And then you go to 18. 18 is a slight improvisation over an earlier question number 10 or question 11 I think we have done. 19 we have already covered. So this is probably your last question for this chapter. Akar Limited signed on 1st April 11 a construction contract for 1 crore 50. This is the transaction price. Following particulars are extracted in respect of the contract for the year ended 31st March 2012. Materials used 71 lakhs, that will be a part of cost. Labor charges paid 36 lakhs should be a part of cost ideally. Higher charges of plant, maybe to construct this, should be a part of the cost. Other contract cost incurred 15 should be a part of cost. Now labor charges of 2 lakhs are still outstanding. Now even if they are outstanding, labor has done the work, and hence your total labor cost is going to be 36 plus 2, that is equal to 38. It is estimated by spending a further 33.5 the work can be completed in all respect. That is future estimated cost. Now cost incurred till date is 71 plus 38 plus, let us say, 71 plus 38 plus, let's say, 25, that is 134 of cost incurred plus 33.5 yet to be incurred, and hence your total estimated cost will be 167.5. What are you supposed to do? You are required to compute the profit and loss for the year to be taken to the P&L, that is first, and provision for any foreseeable loss to be recorded. Okay, over here if I go to see in my profit and loss, this is a contract with a revenue of 150, overall cost of 167.5, and hence there's a 22.5 I think overall loss. Not 22.5, bad mathematics, 17.5 of overall loss. Okay, now if I look at my regular, that is a provision that I should ideally create. However, if I had to create the profit and loss, I will calculate the contract revenue. Now this is to be based on the stage of completion, that is 115 to the stage of completion, which is your stage of completion would be cost incurred, that is 134 divided by 167.5. So 134 by 167.5 comes to around 80% of the project is complete, and hence revenue will be recorded to the extent of 120 minus cost incurred will be recorded to the extent of 134, and hence there is a 14 loss which implicitly gets recorded. Now ideally should have recorded a loss of 17.5, out of which 14 implicitly gets recorded, and hence you will have to create a provision. A further provision has to be created for 3.5, that is 17.5 minus 14, which implicitly gets recorded, or you can create a provision for 17.5 and after that reverse 14 because 14 is realized, and still have a provision for 3.5 which will be reversed in the subsequent years when that loss actually materializes. So over here, as you can see, the loss to be provided over here should be an additional 3,50,000. 17,50,000 should be the total foreseeable loss, out of which loss of the current year is 14 lakhs, and hence 3,50,000 additional provision is required. 19 is already done, and that takes care of every question that is relevant from a CA Inter exam perspective. You do this and you are kind of broadly sorted with your AS7. Okay, so that should take care of AS7. I will see you in the next video with another accounting standard. Bye bye, take care and keep studying.